What was it like to be a hedge fund last week?
It was miserable. You know, what happened, in fact, was basically a stress test on the system. Everyone has known about the potential for rising rates. There was very little of actually new and shocking at the time, just a confluence of events that created this stress test, and a lot of funds failed.
I want you to listen to what Larry Fink told me yesterday. He, of course, is not a hedge fund guy. He runs the world's largest asset manager, BlackRock, $4.5 trillion. And he watched some of this stuff from a position of relative calm. This is Larry Fink.
Much of the blood was fast money, was in many cases leveraged money. I think the volatility was so great. Some of the what I would call the best of the professional hedge funds, they have loss limits. And many of them hit their triggers or loss limits, which means they have to sell all their positions. So I think all those triggering mechanisms created the aggravated market.
The unwind.
The unwind. And I think the unwind was serious, and I think there was some major blood as a result of it.
So, Fabio, there has been a weeding out, if you like, of hedge funds over the past couple of years because so many strategies have not been working. Now we see market volatility, hedge funds failing. What does it mean for the industry?
Well, I think, particularly some hedge fund sector darlings are absolutely going to come under pressure. You look at something like special situations or event-driven funds. The theory in event-driven funds is, you're long the company that's being bought, you're sold the company that's doing the buying. The reality is that the performance of the event-driven funds over this time period was absolutely dismal. Their argument has long been, we don't need to hedge because we are in such specific positions that they're, not related
like to Shire.
Right, exactly. And then next thing you know, when the market pulls down, in reality, the average event fund was shown to be in no way, shape, or form market neutral, and not even that dependent on events. They got pounded, and they were in crowded positions, and the average event fund was down more than the stock market was overall. So this whole argument that, we're in stocks that are so special and different, they're not going to move with the market, well, that kind of fell by the wayside. And when you look at the returns over the last, 4 or 5 years, how much of the returns in some of these activists and some of these event guys have, in fact, been the most expensive beta in the world? How much have you really been adding when suddenly when the market's down for once and you're down as much or more, it really makes you question, wait a minute, so when the market was up 30 and you were up 15, you still took 20% of that 15 and pocketed it for yourself. How much of that was your skill and how much of that was capturing half the market? And I think that there will be many more questions to ask about the hedging strategies, particularly in special situations. There are managers out there doing it legitimately. An excellent fund, Stone Toro in Princeton, they do it, and it's been a challenging environment. If you are legitimately hedged, the number of deals in the public market has actually been much, much less than people think. It's a lot of private activity, not as much public activity, and keeping that flat positioning has been what people claim to do. When you look at these results, those midweek results that they sent out to all of their investors, because everyone sends a weekly update now, they all saw these numbers, and even if they claw it back by the end, it's ugly.
How bad were those numbers?
I mean, we saw numbers, from Paulson, who's just not having a great, run for the last half decade.
He had one big hit.
It's, and the house in the Hamptons is paid for. Yeah. I heard down 22 on that front. I've heard down 11 on some other activist funds. I heard Jana had some challenges. Excellent funds.
This is only what? This is only last
just down
week.
To the midweek, yeah.
Because if you look at, we have a chart of hedge fund activist strategies versus the S&P, and it far underperforms, what just the S&P 500 looks like alone.
Exactly right. And then take off of that how much was really alpha, which is what I'm paying you to in 24,
yeah.
And how much of it wasn't. And even in the macro space, Discovery, which tends to be a bit more heavy equity fund, Discovery was at one point down around 11%. These are big numbers for these guys. And the question that Larry Fink put out, is the key one. How many of them got stopped out? How many of these losses did not come back with the rebound? The right thing to do is to weather this storm. But when you're leveraged 5 times,
and that's the harsh lesson of leverage.
Absolutely. The market can stay irrational a lot longer than you can stay liquid.
For what it's worth, believes that there is, even after the post-crisis shakeout, believes there's still too much leverage in the financial system. It's not at the big banks any longer.
It's at the hedge funds.
And maybe that should make you sleep better at night. But it's elsewhere.
Well, we're still at, the concentration of those opinions is extremely intense. If we look at what are the things that, when you ask hedge fund managers, what are you most bullish about? And what you'll find is that it's highly concentrated, the 2 years, the 10 years, a couple of other trades. And everyone's sort of, long S&P, if anything hedging, short Russell. Everybody's short the 2 year, short the 10 year. And that makes sense. There's a lot of smart hedge funds are taking systemic short interest rate views. But if you do that, you've got to be willing to ride this out. If you're taking a huge short bet and you get squeezed, as you saw in that rate, you're going to get killed.